Welcome to Compound Insights, a podcast by CFA Society New York. As always, I'm your host, Rob Rowan. Today we're talking about active share investing with Tim Pollen, CFA. Tim is Senior Vice President of Investment Research and Product Management at Touchstone Investments. He and his team are responsible for product development and finding and monitoring the investment managers that supervise Touchstone mutual funds and ETFs. Before joining Touchstone, he was a principal at Client Decisions. Prior to that, he had roles at RBC Wealth Management and the Private Client Group at Merrill Lynch. Tim earned his MBA from Georgia State University and his BBA in finance from the University of Georgia. So, Tim, welcome.
Thank you, Rob. Appreciate it. Good to be here.
I believe this is an exceptionally important conversation to have on this podcast now because of my belief that we have uncertainty coming up the road towards us in the global markets. And I believe that can benefit from active management approach, although that's a belief system I adhere to. And my sense is that many people think active management is kind of moribund, but it seems to be alive and well with numbers of assets in the trillions. So I like to give a little light to those things. So at the beginning of the podcast, I introduced this phrase active share investing. Could we start with, for practitioners, a definition of active share investing, please?
Sure. We'll start with the basic definition of the concept of active share, and I can expand on that a little bit to kind of go beyond what I think is important in evaluating and identifying active managers who have the ability to create alpha. But the concept of active share really began in the mid-2000s. A couple of professors at Yale University, one of them in particular we have a relationship with now who's at Notre Dame, Martin Kremers, we're looking at some research that was being done. There was an argument going on in the Wall Street Journal at the time about whether a manager of a very large, well-known U.S. equity fund was a closet indexer. And of course, a closet indexing, the way we've traditionally looked at that is R squared or tracking error and said, let's look at returns over 3, 5, or longer years and say, is there enough of correlation there, enough of a determination to say you're a closet indexer? And so Professor Kremers heard that and said, why are they arguing about this? Why don't they just measure it? And so what he and his co-professor did is said, well, let's build a portfolio-based measure. And the advantage, of course, of a portfolio-based measure is that you're looking at a particular point in time, which is current. You can do it over time as well, but I could know today what the difference is between the holdings and the weights in an active portfolio relative to its benchmark. One of the issues about active share investing is sometimes the adversaries to it would say, well, it doesn't measure skill. Well, the professors never said it measures skill. It's just only measuring difference. And the advantage it gives us is the ability to say, okay, well, if I have the ability to invest in an index at 3 basis points in U.S. large cap investing for S&P 500, Russell 1000, then why would I pay a manager active management fees for somebody that's replicating that index exposure or very high level of index exposure? So really that's the concept of active shares, just measuring the difference between an active portfolio or quote unquote active portfolio and its benchmark.
Right. Yeah. And it's, for those of us who are, well, as I like to describe myself, a man of a certain age, we remember when R squared ruled the world.
Yeah,
right? So
exactly.
This is an important change. Now, before this podcast and my prep for it, you shared a lot of really interesting notes, some interesting papers, which we're going to put in the show notes so everyone listening can hear them. But something you just touched on there that I thought was an interesting paper that Martin Kremers did write was about the 3 pillars of active management. The first of which is skill, which is something you said that the first thing didn't measure. So could you talk a little bit about what was in that paper?
Yeah, well, one thing by the way, this is a background. Just in the past week, we did Active Management Academy, which we formulated with Martin Kremers, who's now the dean at the Mendoza College of Business at Notre Dame. And so we bring in advisors and professionals and kind of go through some of that research, some of our application of that research that makes it accessible to practitioners on a day-to-day basis. And one of the things that Kremers will tell anybody that talks to him is that skill is really hard to measure.
Yeah.
Now, to get published, as we all know from reading things like Financial Analyst Journal, right now the way that you have to measure skill to get published is some kind of multi-factor regression, right? It's like correcting for factor exposures, did you add alpha? But of course, most investors are a lot simpler than that. And I think the important thing is kind of like there's no perfect way to measure skill. There's a lot of different ways that can work, but I would say, so you can't get it perfect, you can get it better. And when I say you can get it better, what we know from other academic research, in fact, there's a paper written by, I think he's now the head of the finance department at Ohio State University, Itzhak Ben-David. He wrote a paper recently that suggested there's only one statistically significant driver of flows into mutual funds. His original abstract said Morningstar ratings specifically. I think he backed off that and made it more generic, over time. But we know that people chase performance. We get into this business, and one of the first lessons we're taught is buy low, sell high. But nobody applies it when they're looking at money managers or mutual funds. So people want to buy at the peak of relative performance and then expect to be able to extrapolate the excess performance. So if we know that that's what people are doing to pick funds, and then there's, you've read the studies, Rob. There's plenty of studies that show whether it's candidly it's retail or institutional investors, the performance after the selection actually frequently underperforms the manager you replaced. So people are chasing performance to their own detriment. And so that's why I think by looking at things a little bit different when it comes to skill, not ignoring what we're behaviorally biased to look at, which is that bright and shiny object. So star ratings, just people are drawn to. Category rankings, peer rankings, people are drawn to. But if I can layer on top of that some other measures, things like consistency over rolling 5-year periods, risk adjustment based on peers, based on benchmark, those kind of things can help me to determine, is this a manager that's just a flash in the pan, or is there somebody that's really actually delivered skill on a relatively consistent basis over time?
Yeah, I mean, that is an excellent way of taking one of the basic heuristics of behavioral finance, the hot hand fallacy, to a much more complex level, right?
I was thinking about really hot hand this morning, Rob, and it's one of the things that the research that shows hot hand, it says it doesn't sustain itself past, I think, 12 months or something.
Yeah.
But candidly, I think all they're capturing is sustainability of short-term performance of factors, right? Because underlying any active manager, there's some kind of factor exposures. I don't think it makes any common sense to us to say, you know what? Skilled managers have a hot hand, so when they're picking individual stocks, they're really good at it for like 24 straight months, and then all of a sudden it goes away. It's really, you can be a good stock picker that has tailwinds or headwinds with respect to your factor or environmental exposures. And so I think some of that research on hot hand is really just picking up the factor piece of the equation.
Yeah. I mean, I think this is one of the things that happened at both times, makes me wonder about research in general, is that we had the need to publish coincide with one of the largest expansions of the public markets in history.
Yep.
So I wonder how much more data we need in there to kind of get that out. But that's a different podcast. But an exceptionally interesting one. I wonder if you could talk a little bit about how you use this, because you're often in a due diligence role.
That's right.
And due diligence on active managers is exceptionally tricky for a lot of the reasons you just laid out. Mm-hmm. So could you talk a little bit about where the rubber hits the road with that in your due diligence work?
Yeah. So we take, there's a 4 or 5 Ps that we all know and love, and we learned when we're evaluating managers, and every firm's got a little bit different approach to us. We do the typical qualitative effort from a due diligence standpoint. You have to look at things like, the firm's stability with respect to its P&L, people, its investment discipline, and how that's being applied, its infrastructure that surrounds the investment process and allows it to function on a daily basis. So I won't go into a lot of detail on that. Kind of a subcomponent of it, though, is what we'd reference as kind of, you've got that active share underpinning, because our brand is distinctively active, which means that if you come to Touchstone, you're expecting not to find closet indexers. You're expecting to find something that gives you a very differentiated ride, experience from a risk-return standpoint than cap-weighted benchmarking would be. And when I say passive or we say indexing, academic papers for decades now have pointed to cap-weighted benchmarks as what they describe as the market. Of course, it's just a subcomponent of the market. The market's actually much bigger. It would include art and commodities and a lot of other things. But for the benefits of saying, let's just talk about U.S. equities, things like the S&P 500, the Russell 1000, and public equities at that are decent reflections of what indexing and passive would be. So you're going to get very distinctively active investing when you come to Touchstone, and the way we try to define that is it's a subset of active management. Passive is cap-weighted indexing. Active is everything else. When we get inside of active, then it's so-called active, is what we're trying to avoid is closet indexers. We're trying to avoid strategies that have become asset bloated, candidly. I mean, they're not liquid enough now to be able to participate in the breadth of the opportunity set. And so what happens, they end up having to be most concentrated in the largest, most liquid stocks and I'm talking about stocks, some of this applies to bonds as well. And finally, we don't want a manager to be over-diversified. I mean, if we find a manager we think is skilled as a stock picker, then we don't want them to diversify away all of the excess return capability from investing in their best ideas. We take that kind of background, and there's a lot of problem with that in the marketplace. If you look at the mutual fund marketplace in the U.S., 75+% of the assets invested in large cap funds and small cap funds are invested in mutual funds that are one or more of closet indexer, asset bloated, where they've eliminated 50% more or more of their opportunity set, or over diversified.
There are a couple other factors that are impacting it right now. I wonder if you run into these. Because of the oligopolization of several industries, there's a natural trend towards that. Because certain parts of the bond market kind of closed up shop for a while. I'm talking about high yield. So there's some issues there too. I mean, do you see that filtering through into a greater challenge for you in your due diligence role?
Well, you always have to account for the environment, right? And if environments change, then opportunities change. On the equity side, certainly the dispersion of returns is a portion of what creates the opportunity for equity managers. On the bond side of the equation, it's an interesting, thing. I mean, conventional wisdom is much different, as you know, as far as active management in bonds than it is in stocks. I mean, people believe that bond managers can add value. And in general, the conventional wisdom on the equity side is there's a lot of people that say, well, it's not possible. I think that the interesting thing about bonds is a lot clearer, because you think about it, if you build an index based on capitalization equivalent, it's, the more indebted you are, the bigger portion of the benchmark you are. So people would say, why would I ever follow an index like that? The other thing about bond investing is it's impossible to truly be an index investor. The ag strategies are not truly replicating the benchmark. So it's a kind of special case there on the fixed income side.
Yeah, it is. And it's a massive, the way you just said the fixed income side, it's also massive. So it's hard to ignore if you're advising, say, a wealthy individual in that who needs it to some degree or another. Well, getting back to this, the active management topics, what I think is really interesting is what other kinds of issues are you seeing in your due diligence process with specific to managers right now? I'm particularly asking this because at CFA New York, we have a whole series that's based on asset owners who are in that role all the time. And some of them have been talking a little bit about saying no a lot more often lately for structural reasons, for sort of sustainability reasons, not climate, but the age of the principals and some other things like that. Are you running into any of those things?
I don't know if I'm following the question.
Sure. Some of the complications that have grown is because there aren't not a whole lot of new firms in the last 10 or so years. There are some firms that are, if you're looking at making a, relatively long-term investment in them, some of those firms are going to have a transition at some point in the next couple of years because of the age of the main principals.
Yeah.
That's becoming more common. There are also some issues, like you just said, with bloat in some of the areas that are, some people also mentioned. Then the other thing that is an overall issue is how the principals will be affected and how their decisions will be affected by higher rates.
Yeah, I mean, to get to the issue of generational structuring of people within an organization, active management organization, I just read an article this morning that was talking about the fact that active managers have gone away almost entirely from the single named PM approach, right? Nobody wants to be associated with just one star manager, especially if you want to be a going concern that has a sustainable ability to gather and then maintain assets. And so that's one of the tricks. It's one of the elements that you have to pay attention to is, how are they developing multi-generational talent? How does that multi-generational talent apply the investment discipline that the firm has become known for in a consistent basis? And by the way, I'm not one that believes, and I've heard some people say this over my career. Probably earlier in my career I might have thought like this, but sometimes sitting down and doing due diligence, managers will say, here's how we evolved an element of our process. We did a lot of research. We found that this worked. We tweaked our process to add this component to it. And some people treat that as a warning sign. Oh, I'm going to walk away. I'm not going to look at you for another 5 to 10 years because you changed the process that I knew. I think it's every good industry and every good firm evolves. And we have to expect and allow that our managers are going to evolve. But what we also have to do is challenge them to say, is there solid underpinning for why you did it? It's not just a whim. It's not just a tweak. It's not we underperformed last month or last quarter, and so we tried to do something to catch up. So that's a difficult thing, but I think it's a worthwhile effort to dive in deep to those kind of issues. In fact, if managers aren't changing, we should be asking them, why are you not trying to evolve and evaluate how the environment around you is changing and what you can do better?
Right. That's the most valuable tool in a due diligence expert's box is the question why. Right.
Yeah.
Yeah.
Exactly.
It's the whole thing. I guess the one of the things, as I said, I'm going to put a whole lot of this research into the show notes, but I would like to encourage everyone who's listening to this podcast to go to Touchstone's website because you all have some really good, maybe good for client consumption videos and written things there. So I would encourage everyone who's listening to this podcast to go check those things out. Also, I'm going to send you a whole bunch of SSRN links so that you all can enjoy, as I know all CFAs do, enjoy a little more research. So Tim, thank you for being here and speaking with us.
Thank you, Rob. I enjoyed it.